Every day, more than 60 million people walk into a McDonald's somewhere on Earth. They order a burger, maybe fries, maybe a coffee. They think they're buying fast food. They're wrong. Because behind the counter, behind the menu boards, behind the smiling cashier taking your order, there is a financial machine so quiet, so well disguised, that most people who study business for a living still don't fully understand it. McDonald's is not primarily a burger company. It is one of the largest owners of real estate on the planet. And the fries, the Big Macs, the Happy Meals, those are just the mechanism that makes the real business work. Stick with this one because once you see what's actually happening under the golden arches, you will never look at a fast food restaurant the same way again. Ask almost anyone what McDonald's does, and you'll get the same answer. They sell burgers. They're a restaurant chain, maybe the biggest one in the world. That's not wrong exactly. It's just incomplete, in a way that hides almost everything interesting about the company. McDonald's operates in more than 100 countries. It serves food faster and cheaper than almost anyone on Earth. It has spent 70 years building one of the most recognizable brands in human history. So naturally, when people try to explain why McDonald's is so profitable, they talk about efficiency, standardized processes, cheap ingredients, clever marketing, all true. But here's the strange part. If you actually open McDonald's financial reports, the documents they're legally required to publish every year, you'll find something that doesn't fit the story everyone tells. A huge share of the company's revenue doesn't come from selling food at all. It comes from something else entirely. It comes from rent. McDonald's Corporation, the parent company most people picture when they think of the brand, owns or holds long-term leases on enormous amounts of land and buildings, the actual physical real estate that McDonald's restaurants sit on all over the world. Then it turns around and rents that property to the franchisees who run the individual restaurants. Let that sink in for a second. The local McDonald's near your house probably isn't owned by McDonald's Corporation. It's owned and operated by an independent business person, a franchisee, who paid for the right to run it. But in a huge number of cases, that franchisee doesn't own the land or the building underneath their own restaurant. McDonald's does. And every single month, that franchisee writes a rent check to the parent company, on top of the franchise fees and royalties they already pay just to use the name and the system. So when you buy a Big Mac, part of that money eventually becomes rental income, flowing up to a corporation that, in a very real sense, functions like a landlord wearing a fast food costume. That sounds almost too strange to be true, until you look at where the idea actually came from. To understand why this happened, you have to understand the deal McDonald's franchisees actually sign, because it's a lot more layered than pay a fee, get a restaurant. When someone becomes a McDonald's franchisee, they're not just licensing a brand name. They're entering a financial relationship with several distinct income streams flowing back to the parent company. First, there's an upfront franchise fee, the cost of buying into the system in the first place. Second, there are ongoing royalties, typically a percentage of the restaurant's monthly sales, paid to McDonald's Corporation simply for the right to operate under the golden arches. And third, the part almost nobody thinks about, there's rent. In many McDonald's locations, the corporation either owns the land outright or holds a long-term lease on it, then subleases the property to the franchisee at a markup. The franchisee builds their business, hires their staff, serves the food, and manages the day-to-day chaos of running a restaurant. McDonald's Corporation, meanwhile, collects rent and royalties whether that particular Tuesday was slow or the drive-through line stretched around the building. This is where almost everyone gets it wrong. They assume McDonald's makes its money the same way any other restaurant chain does, by selling food at a markup. But the corporate parent barely touches most of the food at all. Franchisees buy their own ingredients, pay their own staff, and absorb almost all of the operational risk. McDonald's Corporation sits above that entire operation, collecting steady payments regardless of the day-to-day grind. That's only half of the story, though, because the real question isn't just how this system works, it's why anyone would design it this way in the first place. Imagine you're trying to build the largest restaurant chain in the world. You have two basic options. Option one, you open restaurants, hope they succeed, and hope customers keep coming back. Option two, you build a structure where, even if a particular restaurant struggles, you still get paid, because you control the ground beneath it. Owning the land does something almost nobody expects. It doesn't just create another revenue stream, it fundamentally shifts who holds the power in the relationship between the company and its franchisees. If McDonald's Corporation controls the property, a franchisee who wants to leave the system, break their agreement, or run the restaurant poorly can't simply walk away and keep operating under a different name at the same location. The lease is tied to the franchise agreement. Lose the franchise, and in many cases, you lose access to the property too. That gives McDonald's enormous leverage to enforce quality standards, protect the brand, and keep the entire system consistent, from Ohio to Osaka. But the benefits go even further than control. Real estate tends to appreciate over time. Rental income tends to be stable, even when sales at an individual restaurant fluctuate. And because McDonald's negotiates leases and purchases property at a massive global scale, it can secure locations and financing that an individual franchisee never could on their own. In other words, owning the real estate doesn't just add income. It reduces risk, increases leverage, and gives the company a form of financial gravity that a simple restaurant business could never achieve. And this changes everything about how you should think about McDonald's as a company. To understand where this idea came from, you have to go back to the 1950s. And to a milkshake mixer salesman named Ray Kroc. Kroc didn't invent McDonald's. That credit belongs to Richard and Morris McDonald, two brothers who built a highly efficient burger restaurant in San Bernardino, California. Kroc discovered their operation, was stunned by how fast and consistent it was, and convinced them to let him franchise the concept nationally. For years, though, the franchise business was thin. Franchisees paid modest fees. Growth was real, but the profit margins on those early deals were nowhere near what Kroc believed the concept deserved. The turning point came from a financial advisor named Harry Sonneborn, who joined the company in the late 1950s. Sonneborn looked at the business and reportedly reframed the entire strategy with a single, blunt observation. McDonald's wasn't really in the burger business, it was in the real estate business. And the burgers were simply the vehicle that made the real estate valuable. The idea was elegant. McDonald's would identify promising locations, secure the land through purchase or long-term lease, and then require franchisees to lease that same property from the company, at a markup, as part of their franchise agreement. Franchisees still ran the restaurants, they still handled hiring, food quality, customer service, daily operations. But the corporation now had something franchisees didn't: ownership of the ground itself. This single shift, treating real estate as the foundation of the business rather than a side detail, is arguably the most important strategic decision in the company's history. It's the reason McDonald's didn't just become a big restaurant chain. It became something closer to a real estate holding company that happens to sell hamburgers. Once that structure existed, growth stopped being just about opening more restaurants. It became about acquiring more land. Every new McDonald's wasn't simply a new source of food sales, it was a new real estate asset, carefully chosen for its location, traffic patterns, and long-term commercial value. Over decades, this compounded into something enormous. McDonald's became known not just for its menu, but for its almost uncanny ability to pick high-value real estate. Corners with strong visibility, high-foot traffic, easy highway access, the kind of locations that appreciate steadily over time regardless of what's being sold on them. As the company expanded internationally, this same playbook followed. Land and long-term leases in growing cities across dozens of countries, tied to a global franchise network that kept expanding, decade after decade. The scale is difficult to overstate. Across its global operations, McDonald's holds real estate interests through ownership or long-term leasehold in a majority of its restaurant locations worldwide, making its property portfolio one of the largest held by any single commercial entity on Earth. And each new location added to that portfolio didn't just generate burger sales, it generated rent, decade after decade, compounding, quietly, in the background of a business most people assumed was simply about fast food. Here's why this structure is so financially powerful, and why investors pay close attention to it. Rental income is remarkably stable compared to food sales. A recession might make people trade down from a sit-down restaurant to a McDonald's drive-thru, but rent still gets paid either way, because the franchise agreement requires it. That stability lets McDonald's Corporation plan, invest, and expand with a level of predictability that most restaurant companies simply don't have. There's also the matter of asset appreciation. Commercial real estate, especially in high-traffic areas, tends to increase in value over time. So while franchisees are busy competing for market share and managing daily operations, the land underneath their restaurants is quietly becoming more valuable. An asset sitting on McDonald's balance sheet, not theirs. And because McDonald's owns so much real estate, it can borrow against that property at favorable terms, using its assets to fund further growth, acquisitions, or shareholder returns. This is why financial analysts have long described McDonald's less like a fast food company and more like a hybrid, part franchise operator, part real estate investment vehicle. using burgers as the engine that keeps the whole system running. The food gets people through the door, but the real estate is what makes the whole model so resilient. Except, and here's where the story gets more complicated, owning this much property isn't free of risk. Real estate requires maintenance, buildings age, roofs leak, parking lots crack. Someone has to pay for renovations, safety upgrades, and modernization, and that cost falls, at least partly, on the corporation that owns the asset. There's also debt. Acquiring land and property at this scale, over decades, has meant taking on significant financial obligations. Obligations that have to be serviced regardless of how any individual restaurant performs. Consumer behavior shifts too. Changing neighborhoods, declining foot traffic in certain areas, or a franchise location simply falling out of relevance can turn what was once a valuable asset into a liability. Restaurants close, leases get renegotiated, properties sometimes sit empty. And when the broader economy slows down, even stable rental income streams can come under pressure, as struggling franchisees find it harder to keep up with lease payments layered on top of royalties and operating costs. Owning real estate at global scale isn't a guarantee of endless profit. It's a strategy that carries real financial weight and real risk that has to be actively managed. Today, that model faces pressures Ray Kroc and Harry Sonneborn never could have imagined. Delivery apps have changed how people order food, shifting some demand away from the physical dining room the real estate model was originally built around. Ghost kitchens, delivery-only operations with no storefront at all, raise a quiet, uncomfortable question. If you don't need a visible location with parking and seating, how much is that expensive real estate really worth? Retail patterns are shifting too, as urban centers evolve. Remote work reshapes commuting patterns, and once prime locations near office buildings see less predictable traffic than they used to. McDonald's has responded by leaning into drive-through efficiency, digital ordering, smaller footprint locations, and delivery partnerships, evolving the real estate strategy rather than abandoning it. But the challenge is real. The model that built an empire on physical location now has to adapt to a world where physical location matters in different ways than it did in 1960. So what's the actual lesson hiding inside all of this? It's not really about burgers. And it's not even really about McDonald's. It's about a principle that applies far beyond fast food. The business you see on the surface is often not the business that's actually making the money. McDonald's built one of the most successful companies in history by asking a question most entrepreneurs never think to ask. Not, how do I sell more product, but what do I actually control? And how do I make that control valuable, no matter what happens to the product itself? For McDonald's, the answer was land. Physical, appreciating, income-generating land layered underneath a business that looked, from the outside, like a simple restaurant chain. That's the real insight for anyone building a business, investing money, or trying to understand how wealth actually compounds over time. Ownership of the underlying asset is often more powerful and more durable than ownership of the product built on top of it. The next time you see the Golden Arches, you probably won't just see a burger chain anymore. You'll see one of the most successful real estate strategies ever built, quietly operating in plain sight, disguised as a drive-through.